Joe Morrison, giving the Financing 101 presentation tonight. And this is kind of a high level, anything from raising money from your friends and family to raising from venture capital funds, which, is a whole different ballgame in itself. So we're not going to dive too deep on technical points, which I think are covered really well, actually, especially for early stage entrepreneurs online. Some of the premier venture capital blogs in the country, which I have at the end here, have great details on how not to be diluted down or how a specific deal term will help you keep portions of your company. This is just generally about how to approach the process and the different options that you have when raising funding. So pretty high level. So as far as considerations and funding, I think there are three big pots of money that most people think of. So friends and family is going to be anyone who, if you are going to get 10, 50, $100,000 from grandparents, anyone, uncle, brothers, the person that you grew up with who won the lottery, whatever you want to do. Then angels, which is, kind of the midpoint on you're not raising money directly from friends and family, which is a, really informal arrangement. A lot of times it's going to be in the form of a loan. Angels are going to be people who are more familiar with the space. They like to actually do this. They make multiple investments, either a quarter or a year, and it's something that they're very familiar with the risk of early stage investing. It's also a small subset of people because there are pretty stringent net worth requirements, and often angels will come together in funds to get over the thresholds of net worth so that they can be part of syndicates that will source deals and invest together. And it's not quite all the way down the road where you're raising from venture capitalists and the terms are serious, and they like to be involved, but they're not as involved as venture capitalists in the day-to-day. Board seats are not something that's always up in an angel round, whereas they always are in institutional money. So that's kind of the mid-level where you're starting to get serious. You've got some product, some minimum viable product that you can show off. You're, not just in the ideation stage, but you're not quite serious enough to get, $1 million, 2, 5, 10 million from venture capitalists. And then kind of going all in on the financing is anything from a formal seed round to more of a traditional Series A, B, C round with increasingly large venture capital funds, which are specifically formed vehicles of really sophisticated institutional money that come together in a fund and they just invest. The deal flow is really high. They've always got 10, 15, 20 people in the pipeline looking to invest in, and these are, the terms are going to be serious, the process is going to be serious. It's not going to be a doc light approach to, hey, we'll just throw something on a piece of paper that evidences our relationship. It's, here's our purchase agreement. We want board seats. Here are the actions that you guys can't take without asking us. So that's kind of the spectrum that you go through, from friends and family, which is, I want your money, hopefully this works, to VCs who it's the real deal. So I think a key in figuring out where you want to be on the spectrum is, what do you need? So do you just need cash to build your initial product? Do you want somebody's Rolodex, which I think is a great thing for angels? You get the network. You can start to make introductions or have the angel make introductions for you to the East and West Coast, or within the Midwest to Chicago. Or do you need somebody to help you actually bankroll and introduce you to engineers, introduce you to salespeople, bring in a hired CEO to help you execute your team, manage the team? As you start to have more elaborate needs in actually building your team and getting introductions, you get farther towards the venture capital investors. And then, who do you need? Like I said, I put up here friends and family for cash, angels and VCs for the execution, mentoring, the introductions, and just somebody that you can bounce ideas off of that will give you very good feedback in return. And then the corporate VCs is actually a subset of venture capitalists who have deep industry experience. Some of Michigan's top corporations have venture arms, and they're looking constantly to develop, smart car technology, a niche pharma product, a niche software product, and they are always looking. They're not sourcing as actively as just pure VCs are, but they're always looking for, something in my industry that will strap onto the product that I already have and really complement my business. Tremendously helpful for just pure execution, or if you're looking for an early exit, a lot of times corporate VCs are a very interesting option. So what are your goals? A lot of people, and I didn't really talk about debt, I will in the upcoming slides, but a lot of people say, I don't want to give away equity. Well, one of the great quotes that I read last week was, a slice of a watermelon is a lot more than a whole grape. So you can keep all the equity you want. You can keep 90% of the company and then end up paired with somebody who may be, less complimentary as a partner, or you may have to step it up, give up some equity, and you get a phenomenal partner. And I think, the latter is really what I tend towards. A lot of people fixate on equity or the VC coming in and trying to run your business, and that's a serious problem. But if you find a great partner, whether it's angel, institutional VC, corporate VC, that should really be the focus of the whole fundraising process. And so equity financing, like I said, you give up your equity now at a specified price. So this is the classic pre and post money valuation. Everyone says, oh, $2 million pre, this guy's giving me 2.2. And that's what your company is worth before the money comes in. And people get obsessed with the headline number. And they get obsessed with how much equity they're giving up. And it's tough because that, it's a simple calculation, but it gets an outsized share of the attention. And I really think probably too much of the attention, because if you go down, what does your company give up? The share of the equity is not as important as, do you give up a board seat? Are you giving up 2 out of 5 board seats? What types of things does the investor have control over? So veto rights. And you see at the bottom, terms to review that can be overlooked. Everybody focuses on that top line dollar, and not everyone focuses on the bottom line. What are the control thresholds? Do you have to get 60% of the VCs to agree for you to sign a contract that's $100,000? Do you have to get them to agree to sign on a C-suite executive to get rid of the founder if there's a problem? So, who's running the business after they invest is way more important, especially in the early stage, than the number, because hopefully in 2 years you're going to be worth 30 times this, and they want you to as well. But if dealing with the VC or the investor becomes a headache, it wasn't worth the higher pre and post money valuation. Liquidation preference, I put in there anti-dilution protection too. If you raise $2 million now and then you come on hard times and you have to raise more money at a lower value, how much is that going to cost you? Because the VCs or the institutional investors, obviously, they take precedence. They put the money in there. They've got the dollar, the financial risk. But how much downside is there for you? Are they going to take an outsized portion of your equity later if you have to raise at a lower valuation? Or if you need to go out and you're desperate for money, are they going to crank up their percentage threshold at your expense? So that's key. And then size of the option pool is just another one that's out there. A lot of people say, I don't need an option plan to attract employees, which is kind of the standard way that a company will attract its employees. Standard option pools are 10 to 20% depending on what people say. And you should just bake that in right now as, I own 100% of the company. As soon as I go out and raise money, I'm taking 10 or 20% and putting into the bank for future employees, because they will, in good institutional money, whether it's now or down the road, will require you to take a portion of what you own in the company and put it in the pot for attracting, top developer, top marketer, top C-suite exec. So, focus on who gets what say where over veto rights of decisions, how often you have to check in with them, what types of reports you have to give them. Those are kind of the key items. So the next one is debt versus equity financing. And debt financing, I kept it until the middle, but is very, very popular and is a great route, especially from the friends and family rounds, especially in the angel rounds, because it's not just sinking $500,000, $1 million into a company. They're giving you debt that can potentially convert into equity later if something good happens, but also, the debt, if it goes away, you have certain positive tax treatments for people who, lose all of a loan. So it's a write-off on tax and things of that nature. You keep 100% of your company. You do owe them $500,000, $250,000, however much you got from them, but it is all yours right now. They don't have the sorts of, in many cases, until you get to larger rounds raising debt, they don't have the sorts of controls on your company. So it is kind of still your baby, proverbial sense. And most of the debt is not just $250,000 where poof, it goes away if somebody else invests. Usually if somebody comes in later and sees you're growing and you're successful, that $250,000 converts into whatever the next investor puts into the company. So if you later raise an A round, their debt will convert from debt into Series A preferred shares. So the debt goes away, but it didn't go away for free. And it does give them a tremendous upside because they put in 250, and a lot of this debt says we're only going to use this 250 to pay 80% of the later shares. So they get usually dividends and interest in the meantime. It'll convert over, and then they get a discount on what the later investor is paying. So it can be a phenomenal deal, and it's very available to early stage companies. So it's not something, you see a lot of people talk about, I raised a convertible note round, I raised a small debt round, and this is what they're talking about. So you are definitely taking a risk because now you have $250,000, $300,000, $500,000 of debt sitting on your books. And the investors do get quite a bit of the upside, but like I said, you did keep 100% of your company, probably less interference in the day-to-day, especially in the early convertible debt rounds. So very popular. I put up, again, terms to ask your lawyer about, as opposed to going knee-deep at the mechanics, which are on the blogs. I think liquidation preference, later when you're looking at conversions to equity and automatic conversion into equity when it happens. So it will automatically happen if you raise $1 million from a venture capitalist. That's kind of, that $1 million or more is popular. And then the person who holds the debt has no choice. They're automatically ushered into equity. So the person who invests later, the venture firm, they don't want to let the $250,000 set out there. It is automatically ushered into whatever the round is. So you want to see how much money you have to raise to force that debt holder's hand to come to the equity side of the table. So that's, a popular figure is what is that threshold, caps on that threshold, and this starts to get a little bit more technical, but if you have $250,000 of debt and the person has friendly terms, they're going to get a cap on what it is. So even if you raise money and the venture capitalist says, wow, your growth is fantastic, your company's worth $20 million, the debt holder might have a term in their note that says, even if you're fantastically successful, I'm going to convert when your company's worth $5 million. So they would get a huge discount because they're able to buy into your company as if it were worth 5 and everyone else is coming in at 20. And then they get certain discount off of whatever the per share price is, even if it was at a lower value. So you need to make sure that the convertible debt is kind of market terms, that this is somebody that you're fine with being a partner and an equity holder if their debt does convert and you are successful. So it's not just a one-off, hey, I'm getting a bank loan and I'm going to dispatch this person soon. They might be on the same side of the table as you relatively quickly if you do grow. The cap, I talked about that. And then early convertible debt, I think is great because people worry about a lot about legal fees. And early convertible debt can be super cheap. If it's one-off, 2, 3 notes, you're around $200,000, you can just sign, you know, there are some pretty great forums that are floating around from accelerators. A lot of the West Coast accelerators have forums that they just give away free on the web. You can sign convertible notes, and they're relatively good forums. As soon as you hit 200, 250, 300,000, it starts to get a little dicey, and you might want a lawyer, you know, to review it. If you get more people involved, you might want lawyers to review it. But if you're dealing with 1, 2, 3 people, and you're raising $150,000, you can do it really, really cheaply, and the investor can probably provide a, you know, pretty solid counsel to review something for not very much money. So the next one, you know, try to transition a little bit out of the mechanics of it, because like I said, you know, you want to be, with a little Google searching, you can find what market terms are. You know, you don't, if something in what you're presented with sounds too good to be true or sounds too rich for the investor, a lot of times it is. And a lot of prominent venture capitalists have great blogs on, you know, what's market versus you know, I felt like I was getting crammed down. Now I see this website, I am absolutely getting crammed down. So, you know, we'll leave the nuts and bolts, which change. You know, a lot of it is just making sure that you're getting kind of the good deal, in line with whatever the industry is, and it can be very industry specific, whether it's, you know, pharma, med tech, straight software plays, other types of things. There are different terms depending, but you know, the internet has just fantastic coverage of what are market terms. So tips for early startup fundraising, I think, you know, never let anyone get off the hook without giving you another name. You got to put a ton of weight on the angels network. So either they have a tremendous background in the industry or they have a fantastic Rolodex. You know, that's just key, because you're always thinking where your next dollar is going to come from. So when you raise a round, it's not like you're done for 6 months or you're done for a year. You raise a round, and kind of the, you know, the proverbial thing is you're just never done fundraising. You go from one round to interviewing your next investors and them interviewing you. So you just want somebody who can put you on the lunch circuit, who can introduce you to software engineers, who can introduce you to fantastic talent. So the Rolodex is huge. I think lawyers are also great sources of introductions. You know, some people may be a little bit skittish about making introductions to their clients, but you can get a lot of free lunches from lawyers, which is not a surprise, and get a lot of names kind of off the top of their hat, or off the top of their head. You know, they keep dozens of cards in their pockets. So educate yourself on the trends and the terms. Test the market. You know, if you're getting serious interest from one group of angels and the terms seem pretty friendly, go kick the tires of another angel group. Go to Lansing, go to Grand Rapids, you know, go test some of the Detroit area, the northern suburb angels. If a deal is too good, there's probably, you know, other money out there that you can find. You can find more money. Don't just rest. And it's, you know, Michigan has a phenomenal bench of angels and seed stage companies that you can totally kick the tires. And a lot of them do club deals, so you'll see a lot of them kind of come into rounds to form bigger A or B rounds. But still make sure that you've really gone through and, you know, tested what terms you can get from what different groups. The process can be ridiculously lengthy, and you wanted to close 2 weeks ago, but the lawyers are still going back and forth over something that may or may not matter. Full disclosure, it does happen, but just be patient. You know, things will drag out, and that's why, you know, you don't ever want to get caught in the situation where you only have a month's worth of burn left. And that's why you're always fundraising, because if you think it's going to take a month, it's going to take 3. So you just want to be constantly churning, constantly meeting people, constantly looking to take investors. And if you think, hey, you know, this person that I thought wouldn't invest for 6 months is looking to invest now, he's not ready for my current financing. You know, there are different ways that you can extend closings. You can have a first close and take money, and you can get a subsequent closing later from an investor. especially in the small network like Michigan where people know each other, bounce a name out there, see what, if somebody's amenable to another investor coming in a month, they're just not ready today. So you can kind of have open rolling financings for, 1 or 2 months and people will come in. So be aware of that. Don't get hung up on specific terms if it costs you a good partner. You're going to be dealing with all of the venture investors. You're going to have to be, on the phone with them, asking for their permission for X, trying to possibly get more money out of them later. So find somebody that you work well with. It's kind of my general advice also about lawyers. Don't go for the, cheapest option if you think somebody who's slightly more expensive is somebody that you enjoy working with. It's just crucial in the angel and venture capital space. Find somebody that you actually think you have a good relationship with, is willing to hook you up with other people, and you don't feel like it's just crushingly painful to call them on the phone and ask a question about how you pivot or how you execute, and don't feel like you'll look stupid in front of them for asking, because that's what they're there for, is to help you refine and help you grow. Also, the last bullet is not particularly self-serving, but talk to as many lawyers as you can, because there are a lot of lawyers. There are many of us out there. You get a ton of free lunches probably, or coffee, if you don't have time for lunch, but find somebody who has a robust startup practice, so they're going to be able to flag the bad term, or they're going to be able to explain the term to you that is not market. Or if you say, wow, this is weird, and you want to be educated about a term in a doc, you're the client that's, you're right to get things explained, that they're not just going to say, well, let me do my job and I'll, close this financing. So find somebody that is actually going to be, patient, that has a startup practice, that understands, the area, that has a feel for East and West Coast terms, that has a feel for the space, because they're, hopefully if you find a good lawyer, they can carry you through multiple financings so you're not hopping. But, go out there and find a really good partner who can make the introductions for you. So resources for fundraising, I mentioned all the blogs. I'm a huge proponent of kind of the new trend where venture capitalists have blogs, and they're incredible. Fred Wilson's A VC blog is one of the industry standard blogs. It goes anywhere from deep dives on anti-dilution and the pros and cons of certain equity terms, to talking about what's market, to talking about how to deal well with board of directors or other employees, independent contractors versus employees. So it's not just financing. The second one is Steve Blank, and he's one of the most famous Silicon Valley investors and entrepreneurs ever. He now teaches at Stanford, kind of his own. He's given free reign over their entrepreneurship program, more or less. He's got a great how to run and execute a focused blog, so not really on the nitty-gritty, but some really useful wisdom there. Mark Schuster, both sides of the table, like Fred Wilson, I think they're both Manhattan guys, but his stuff, Pitching a VC, is a phenomenal post on how to get up there and just let it roll when you're trying to raise money. And I think Reid Hoffman's his post on pitching, and actually LinkedIn's Series B slide deck is there, and he breaks down his own slide deck in 15,000 words and goes really deep into what makes a good pitch, puts you inside of the mind of an angel group or venture capitalists, and it's a great post, kind of a must read. I think as far as books, another must read is Venture Deals by Brad Feld and Jason Mendelson. Jason Mendelson is a Michigan law alum, and I think he practiced for a couple of years and then hopped, and is now basically a godfather of the Boulder startup scene. I mean, Brad Feld and Jason Mendelson created the Boulder startup scene, more or less. Our VCs at the Foundry Group, just incredibly insightful guys. Venture Deals, basically their thing is they try and cut the lawyers out of it, so help you understand how to be your own lawyer, and how to lawyer most of a venture deal, so you're not stranded, with somebody who's either not serving you well, or you can kind of check what the lawyer's doing, so you know that you're getting good representation. And then I think there are a lot of good resources on the internet, AngelList and Crunchbase, if you're just trying to look at what terms have come down recently. Crunchbase has a list of financings. AngelList is, you can go as a company and put yourself out there and find angel investors who are willing to source deals basically from the internet. And then CB Insights is one that I use a lot. They have great PowerPoints quarterly about deal terms, so what the average pre-money was, what the average size of the round was, how many deals are happening where, who's leading the most deals. So CB Insights is more of a hard numbers site, whereas the others, and especially the blogs, are kind of softer factors, but those resources are just awesome. So I think that's it, short of the last, a local angel's thought on financing. Find the best business partners, because, who knows? Everybody's going to tell you there's a different threshold. Do you need a business plan? Maybe. Do you need a product? Maybe. How good are you with PowerPoint? Do you want a great pitch? Sure. I mean, some people are, that's going to be the way. So everybody's going to tell you something different, but just think strategically when you're meeting people, who's going to add more to your long-term success? What do you need right now? It's not about the money, as in many cases, unless you're a clean tech startup or you're a pharma where you have to get the money to get over a certain hurdle. You need somebody's Rolodex, and I think that's what the focus is here. The best business partners are experienced, and they're going to be able to really help you provide the services, but kind of mentor. So that's kind of that's the deal. Lots of words. I apologize for my voice, by the way. Any questions? No questions at all.
What were some of the resources? And looking at the notes.
So the blogs have great breakdowns on the actual note mechanics. So talking about caps and what the function of a cap is, talking about note discounts, so how much they'll pay less than the next investor. But CB Insights and Crunchbase have great numbers on just how much was raised in, what rounds.
Insights was separate.
Yeah,
Crunchbase.
CB Insights is one total. It's a blog, but they also have great numbers. Crunchbase is just a whole other fundraising tracking site. So. Sure.
So, do you think venture capital companies will invest in a company that the intellectual property is only copyright?
So the general prevailing thought is that VCs love IP, and they do. I don't think it's the be all and the end all. I think it's more, and it depends, I think it's more product driven than anything, but if it's just copyrights or trade secrets, I don't think Twitter had a patent until it had raised quite a bit of money. So I think the focus more is on product and how you've executed thus far for venture capitalists than, I have 2 patents and they're super secret, so invest in me because that's going to be money. But once you're going down the venture path and you're trying to raise from institutional investors, you're probably going to have some sort of track record and some sort of product, and I think that's slightly more impressive to most. So I wouldn't worry about kind of the lack of a patent. If anyone has to go too, feel free. This Monday night is not the ideal time.
Got a question, I guess. You hear about the East Coast, West Coast. What do you see as the trends in Michigan? Is it picking up, or what's active? The angels, the VCs, or
So, I mean, fundraising has been really easy on the East and West Coast for a while. And Michigan has an interesting hybrid in that it just totally depends on who you're talking to. So I think the East Coast is famous for, you know, this is going to be a contact sport where it's going to be a tough fundraising process and we're going to fight over everything and we're going to take as much as possible. And I think that, I mean, that's just kind of the general East Coast mantra, whereas the West Coast is, you know, friendlier terms generally. Stuff gets done quickly, really well networked. I mean, the East Coast is obviously really well networked too, but I think the terms are just, it's famous for being very founder friendly. I think Michigan, you have a lot of groups that style themselves West Coast. You have some that style themselves East Coast. I think it's actually really helpful to find out who somebody's lawyer is. If they have like a West Coast counsel, there's just a different way of doing it than the East Coast. But I mean, there's a lot of money in Michigan right now. You know, the angel groups, there are just some really large angel groups that source deals really well, whether it's in Grand Rapids that go to Start Garden, whether it's, you know, some angel funds in Ann Arbor, a bunch in mid-Michigan around Lansing. So it totally depends on industry. You know, there's a lot of money for internet and other things like that. And then, you know, who you're going after. There are some newer, small seed stage investors who are just tough with their terms. And I actually think that Michigan generally is a small enough community that if you ask enough institutional investors or enough angels about the terms, they'll be very candid with their thoughts on other ones. So it varies widely, but I think there's a lot of money around, and I think you can kind of find out by asking one or two questions about the thoughts on others, because a lot of them do club together, and you'll see, you know, who's friendly, who's co-investing with others, and you can kind of profile, hey, these guys, you know, I know that one, and they partner with those three other ones, so they, you know, there's kind of that general profile to the group.
So this is perhaps a wild card question.
Sure.
Crowdsourcing, Kickstarter and related. What's your experience and thoughts on that? Pitfalls, benefits?
And so I left it off because I think that it's almost in flux enough that, and you know, people widely disagree. I don't think that it's developed enough that it's a reliable way to say, hey, I'm an equity crowd fund and I'm going to, you know, Jobs Act is great, let's go after it and let's figure out how to do it. I really don't think anyone really knows what's going to shape up. I don't think that there's enough of a history that people know how VCs are going to treat it. So sure, you raise a bunch of money from crowdfunding. Is that going to scare away VCs because now you have 50 small investors that they're going to have to deal with? So the Kickstarter route and the Indiegogo route is great. People can raise a ton of money. It can be a phenomenal platform to help you develop your product. So the free crowdfunding kind of in exchange for product or services, I think, is really valuable if you just want to try and bootstrap it yourself. Whereas the equity crowdfunding route, I think, is a while away. It's a good year from, you know, all of the rules finally coming out and us understanding how people downstream are going to treat it. And I know, you know, people that are kind of my contemporaries are a little skittish about the general equity crowdfunding situation.
Right, so sort of a follow-up on that, then the rules around it, the equity versus just, you know, giving product down the road. I mean, are there SEC draft rules around this, or discussions, or are there blog comments on that? Because it seems to me, you know, you're basically offering stock for all intents and purposes in some way.
So there are tons of, you know, the SEC spent months and months and months and months, well over a year, drafting crowdfunding rules. And there are two levels to it because the SEC is obviously the federal level. You know, anytime you have interstate investing, you're going to fall into the SEC's guidelines. Intrastate investing, so if you only have Michigan crowdfunding dollars, it's a totally different ballgame. It's still very complicated, but states have kind of raced to the bottom to say, hey, we have the friendliest equity crowdfunding market, you know, come here, you can use equity crowdfunding. But I still, you know, enough of the laws are in draft form and there hasn't really been sufficient regulatory comment on it for you to say, you know, usually legislatures write rules that are not actually English and don't provide any guidance. So you say, wow, I mean, what I want to do is kind of between A and it's kind of between B. So you go and you try to get some regulatory guidance, say, hey, how are you going to treat this? There's not a robust enough bank to know how, you know, Michigan would treat it, to know how the SEC would treat things if you fall out of something. And as soon as you fall out of, as soon as you fall out of an exception and start to get into the SEC's world, it gets to be tough.
So last question related to that.
Yeah.
Does something like an LLC as an entity protect you from the potential fallout of, say, running afoul of that? Assuming, of course, that you're not just basically being fraudulent in what you're asking, you know, money for.
So no, not always, because there are certain routes that, you know, if you're out there as an individual selling securities and you haven't obtained the proper licensing, it's not, and it's tough, you know, law treats the corporation of the LLC as its own entity. But if somebody's out there hawking securities and it turns out really poorly, there is potential for liability to come back through. So you're not always, you know, selling through the shield of your LLC.
If you've got a strong relationship with your attorney, you know, there's a desire to bring them into the game a little bit. Can you provide some comments on why or why not to do that?
And it's interesting. It's depending on where you are, you know, West Coast, it's very common. A lot of the big West Coast shops, the partners will co-invest certain small dollars and sometimes not so small dollars. But it really just hinges, it's a lot of ethical rules where, you know, technically, you know, lawyers, you don't want to pollute their business judgment about how best to serve the client with, you know, hey, how do I make sure that my investment stays whole in this until I can get my money out? So there are a lot of ethical rules that actually prevent it, which is why a lot of people outside of the coast where it's slightly less rules focused don't do it. But I mean, I think it's the same thing with, you know, finding a good partner. If it's a good partner, you know, why not? Because would you hire them as the GC of your startup when you have hit a sufficient revenue milestone to justify it? I mean, if you're going to bring them into the C-suite and help them, and they're going to help you run your business, you know, it's also potentially a great investor. But what you don't want to do is start to wall off somebody you trust because of, you know, the bar rules or other certain ethical rules. So if you have a great current function relationship with your attorney, do you want to throw something in there where, hey, they might not be able to do X or Y because now they're an investor? But again, I mean, it's in a lot of, on the West Coast where a lot of lawyers are co-investing, they're at, you know, massive shops. So find somebody else, and it's, you know, there are options within that firm, and a lot of times it's your relationship with the firm that's great, not with that specific particular lawyer. But it definitely does change the relationship. It's just whether you want to kind of pollute that with all the ethics rules, business partner plus legal advisor and everything else.
As far as fundraising from the state itself, let's say the state of Michigan, I guess any pros or cons to think about?
I mean, it depends on which route you're going. So the state has a lot of great grants. I mean, Michigan has tried really hard over the past several years to put out a program where there's, solid public-private partnerships like Spark, or where there are SBIR grants or other types of grants at the state level. There are a lot of competitions, pitch competitions, where the state is helping kind of support the pot. So no, I mean, not really. You just realize that you're probably not going to get the day-to-day person that you can call and get the Rolodex and get the introductions. I think the general thought is that it's more a source of money than it is, hey, somebody's now in the trenches with me. So you'll get money, but will you get a day-to-day business partner whose cell phone you can ring at 7:30 at night? Probably not. So it's just a different source of money. I mean, you could get similar money and similar treatment from a bank, which is also great if you want to go that route. I mean, I know Bank of Ann Arbor has a phenomenal startup-friendly practice that's more traditional banking vein, but they're very interested in helping young startups. So it's just very different.
All right, well, let's give Joe a round of applause and thank him.
Thanks.
And all of these slides will be on the Spark SlideShare account, as well as the video recording of tonight if you missed something, if you want to go back and revisit it later. And thank you all for coming. So have a good night. Thank you.